Hello, I'm Edward Sterling, macro analyst for Bulwark Bullion. Something unusual just happened in the gold market. Turkey sold 58 tons of gold in just 2 weeks. That's not a routine reserve adjustment. That's a sudden release of roughly 1.9 million ounces of gold. More than $4 billion worth of metal hitting the market in a very short period of time. And when a country that has been one of the world's most aggressive gold accumulators suddenly becomes a major seller, markets start asking questions. Is this a shift in central bank strategy? Is Turkey signaling something about gold prices? Or is something deeper happening inside the country's financial system? Because central banks don't usually move that quickly without a reason. Let's break down what's actually going on. Over the course of just 2 weeks, Turkey's central bank sold approximately 58 tons of gold from its reserves. To understand why that matters, it helps to put the number into context. Global central banks collectively bought a little over 1,000 tons of gold last year. So Turkey selling 58 tons in such a short window represents a noticeable chunk of that annual activity. But more importantly, central banks typically move slowly when adjusting their reserves. They accumulate gold over months or years. They rebalance gradually. So when a central bank suddenly sells billions of dollars worth of gold in a matter of days, it grabs attention across the entire precious metals market. But here's where the story becomes more interesting. The sale doesn't appear to be driven by a bearish view on gold. Instead, it appears to be tied to something happening inside Turkey's domestic financial system. The most important factor behind these sales is likely domestic financial pressure inside Turkey. Turkey's economy has been dealing with a difficult combination of forces: high inflation, currency instability, and volatile capital flows. When that happens, Turkish households often respond in a very specific way. They buy gold. Turkey has one of the most unique gold markets in the world because households hold enormous amounts of physical gold as savings. During periods of currency instability, demand for gold can surge rapidly as people look for protection against inflation and a weakening currency. And when that demand spikes, the domestic market can run into supply shortages. That's where the central bank sometimes steps in. By selling gold reserves, authorities can inject physical supply into the market and ease pressure inside the financial system. In other words, this wasn't necessarily a strategic decision about gold. It was likely a liquidity operation designed to stabilize the domestic market. There are a few additional forces reinforcing that dynamic. First is the Turkish lira. When the lira weakens sharply, demand for gold tends to accelerate. Households move savings into precious metals as a store of value. That surge in demand often leads to increased gold imports, which can widen the country's trade deficit and put additional pressure on the currency. By releasing gold from reserves, authorities can reduce the need for imports and ease some of that pressure. Second is market stabilization. When local gold demand surges too quickly, it can create distortions in pricing and supply chains. Central banks sometimes intervene simply to smooth those disruptions. And third is short-term liquidity needs. Gold reserves are one of the most liquid assets a central bank holds. Selling a portion of those reserves can provide immediate financial flexibility during periods of stress. So, how does a move like this actually affect markets? The chain reaction typically looks like this. Domestic economic pressure rises. Households rush into gold as a hedge against inflation and currency instability. Local demand for physical gold spikes. The central bank sells reserves to inject supply and stabilize the market. And that gold flows back into the global market, temporarily increasing supply. In this case, The evidence suggests the sale was domestic and tactical, not a structural shift in Turkey's long-term gold strategy. Before we go further, if you're enjoying this breakdown of the precious metals market, make sure to hit the like button and subscribe to the channel. What makes this story particularly interesting is that it runs against a much larger global trend. Central banks around the world have been buying gold at one of the fastest paces in modern history. Countries such as China, India, and several Middle Eastern economies have been increasing their gold reserves as they diversify away from traditional reserve assets. Geopolitical tensions, sanctions risk, and long-term concerns about the stability of the global financial system have all contributed to that shift. That's why Turkey's sudden sale caught markets off guard. But when you look closely, it doesn't necessarily contradict the broader trend. Instead, it highlights an important point. Central bank gold sales sometimes reflect domestic financial pressures rather than long-term strategic changes. So what indicators matter going forward? First, watch Turkey's gold reserve levels in the coming months. If the selling stops quickly, it supports the idea that this was a temporary liquidity operation rather than a policy shift. Second, monitor domestic gold demand in Turkey. If inflation or currency volatility continues driving strong household demand, authorities may continue adjusting reserves to stabilize the market. Third, keep an eye on global central bank buying trends. The broader story in the gold market remains strong accumulation by governments seeking to diversify reserves. If that trend continues, isolated sales like this may have very limited long-term impact on global prices. The key takeaway here is that not all central bank gold sales mean the same thing. Sometimes they signal a shift in policy, but other times they simply reflect the pressures governments face when managing unstable domestic economies. Turkey's sale of 58 tons of gold in just 2 weeks certainly grabbed headlines, but the deeper story may be less about gold itself, and more about the financial pressures building inside the Turkish economy. If central banks around the world continue accumulating gold, while countries like Turkey occasionally sell reserves to stabilize domestic markets. What does that tell us about how governments are preparing for the next phase of the global financial system? Thanks for watching. If you're interested in gold, silver, and the macro forces driving global markets, make sure to like the video and subscribe. For more analysis, visit bulwarkbullion.com. Link is in description. I'm Edward Sterling, macro analyst for Bulwark Bullion. See you in the next one.